Hey guys, welcome back. So in this video, I wanted to kind of re-up the 3 stocks to watch playlist here on the channel. I know that, with the weeks and weeks that I've been away from the channel, I haven't been doing this month to month, but I figured I'd start it again up for the month of June, and then, continuously do that for as long as I can. So in this video, I'm going to be going over 3 different stocks that are in very different industries that aren't necessarily stocks that I am personally buying right now, but these are stocks that I've been looking at over the past couple of months, and at current valuations, they are getting more and more attractive by the day, and depending on if they hit my buying level, I may or may not be buying a position in any of these stocks. So keep that in mind, full disclosure, I may or may not become a shareholder very soon of these companies, but for right now, let's just get into the video and I'll go over why I think these 3 stocks are worth looking into. And as always, guys, if you like this video, make sure to stick around, hit that thumbs up, hit the subscribe button, and without further ado, let's get into the video. Alright guys, and the first stock on my list is Intel Corporation. Now you guys know that I have been covering Intel Corporation for quite some time here on the channel, and given recent events, I definitely think that Intel is, it's always been a well-run company. However, currently I think it's very hated by the market, and the market isn't expecting anything out of it. And I think that that's the biggest misconception right now, especially in the semiconductor space. In terms of all the companies that, have been hit hard over the past couple of weeks, I definitely think Intel is the one that's been hit almost the hardest without much justification. And so let me kind of go through exactly why I think Intel is attractive right now. So right off the bat, I want to talk about how Intel is significantly beaten down in comparison to other semiconductor stocks over the past month. So, if you just look at the last 4 weeks just by themselves, I believe Intel Corp is down anywhere between 25 and 30%. And pretty much no news directly from the company has come out, that was that negative. And everybody is pretty much foreshadowing a lot of the trade war getting picked up again. Obviously, if China spends less money on building out their tech infrastructure, Intel will not be receiving a lot of money as they do from data centers and cloud farms. However, I do not think that in retrospect, Intel is the one that is kind of the most volatile to this type of situation. I definitely think that the CPU market is much more stable than, say, the memory or the graphics card market. And so I'm pretty confused with the market's interpretation of this and saying, okay, well, AMD and NVIDIA might still have a good couple of quarters, but Intel is, doomed down for the count. Not to mention that Intel is already just starting to unveil their new line of CPUs that they haven't been able to really push out, for roughly 2 years at this point. So assuming they're able to push out their new IT level, like say their server grade CPUs within a year's time from right now during this whole this headwind of the semiconductor industry, I definitely think they're going to be able to take a lot more market share back from AMD than people are expecting, and that's kind of an interesting play in my opinion. Now, looking at this from just a ballpark valuation standpoint, Intel Corporation is currently trading at below a 10 on their forward and on their current PE. And in the semiconductor space, you have to understand a couple of things. One, the whole industry in itself, regardless of the company, goes through a cyclical nature. And, you have companies like Intel Corporation that, yes, obviously they're not growing that quickly, but their PE ratio is getting discounted to about a 10, when companies like AMD and NVIDIA that have a little bit more growth to them, are justifying valuations for some reason between 30 and 90. And, in my opinion, if you look at a cyclical industry and and you understand that, okay, there's going to be ups and there's going to be downs, and everybody's anticipating that there's going to be a downwind right now, and they think that there's going to be, kind of a peak for the recent couple of years, and then the next couple of years it's going to be going, say, down either, 10 to 20% on the overall semiconductor demand. Why would you look at the company that is, arguably the strongest company in the space and the most refined company in the space, meaning its balance sheet is on point, and I'll get into that in a little bit, and it's not going through hypergrowth mode and it's not being priced for hypergrowth? Why wouldn't that be the most attractive play in this segment? So that's something I really don't get, and that's something that's very interesting to me. It kind of goes on with this next point, that I believe that the entire industry believes that AMD is going to be coming out with their new Ryzen 3 and their new EPYC chip line, and they are going to be just demolishing Intel for the foreseeable future. Now, as a PC enthusiast and as someone who buys these components for my own personal rig, I am planning on going with Ryzen 3 for when I upgrade my computer this year. However, I don't believe that the amount of money that is in this space altogether is going to be going to just AMD. As we saw in the last couple of quarters, AMD, yes, their sales did rise, say 20, 30% over the past couple of years, but AMD simply doesn't have enough manufacturing capabilities to meet the demand of the entire market. So either people are caught with two things. Either one, they have to wait an even longer time to get a chipset from AMD that is still relatively new, and when you look at a cloud farm, these people want things to be, you know, pretty much tried and true and have already stood the test of time. Or, you know, they just buy it from Intel that can already pop out as many chips as they want. Now, obviously, their supply and demand issues have been kind of acute the past couple of years, but they were also doing a CEO transition, and a lot of things weren't going in their favor with the whole 10 nanometer. So I definitely think that right now their fabs will be up and running, and they shouldn't have as bad of a supply chain issue as they do currently. And just to wrap things up, again, what I talked about earlier is that Intel's balance sheet is definitely one of the better ones in the entire semiconductor space. So you look at a company like AMD. AMD has a significant amount of debt, and while yes, they are growing really quickly and are able to service that debt, if there is a, say, overall cyclicality downturn, AMD is going to get put in a lot of awkward situations, having to pay off that debt with a significantly slower amount of growth. So like if you look at, say if we have a whole industry decline, Intel could be hit, yes, say 10 to 15% ballpark, you know, just off my rough estimates. But AMD, if that growth goes away and they start to have a lot of pressure put on them from, you know, say their debt interest continuing to go up and their sales are slowing, you can see AMD, you know, getting hit all the way back down to the low teens range. So in terms of risk reward and, you know, like risk adjusted reward, I definitely think Intel Corp is probably the pick in the semiconductor space moving forward. And they also pay a relatively nice dividend. It sits just under about a 3% right now. And now, obviously, you know, who knows how long that dividend will be continue to pay out, you know, say in a recession. But for right now, it's still, you know, extra cash in your pocket. And I think it's very interesting that Intel is trading at these levels. All right, guys, now the next company I wanted to talk about is Tesla. Now, Tesla is a company that I've never really talked about here on the channel. You know, I've mentioned it here and there with some of the really interesting things that go on with Tesla in the news outlets. But it's a company right now that over the past couple of months has been hit hard, almost, you know, north of 50%. And it's very interesting to me that a company like Tesla, that essentially nothing really changed. Yes, while it has been a story stock for, you know, numerous years right now, and there was no real justification to its previous valuation, there doesn't seem to be any more justification to its current valuation, assuming investors were willing to pay, you know, just a year ago for the stock trading at about $300. Things are definitely improving from there. I wouldn't say that they're deteriorating. But for some reason, investors have decided that now the stock deserves a 50% haircut. So I will be making a video on Tesla, you know, a little bit more in depth and exactly what type of value I see possibly getting unlocked in Tesla from an investor standpoint. But currently, it is a company that, while still very speculative compared to other investments that I make here on the channel, it definitely seems like to be in a more favorable risk-reward type of situation, assuming you have, you know, small amount of gambling money and a very long-term time horizon. But I'll get more into that in its own individual video. But for right now, just kind of looking at what makes it intriguing currently is that the stock is absolutely hated. I think everybody in the entire stock market has heard in recent years that Tesla has either, you know, two types of situations. It's either extremely hot or extremely cold in terms of media. And it doesn't really ever seem to be like an okay company or a company that people are just like, yeah, they're growing, you know, at a relatively fast rate, blah, blah, blah. No, it's everybody generally either absolutely despises this company along with Elon Musk, or they think he's going to, you know, save the world and, you know, be the next biggest company in the world. So it's definitely funny with how, like, a celebrity CEO like Elon Musk, you know, probably one of the most well-known CEOs out in the world right now, it's very interesting to see how he interacts with people and how, you know, individuals interact with him. It's just something very funny. But getting past that, nothing really changed. And I mentioned this earlier, is that nothing really changed from what Tesla's story was 6 months ago versus what it is today. If anything, Tesla today is, you know, getting more diverse and, you know, how it's spreading out across the globe. You know, there's really no inherent change with the story. Now, obviously, currently, you can argue that, okay, the new tariffs that are going in from Mexico could spell bad news for a lot of auto manufacturers. In comparison to other auto manufacturers, Tesla's reliance on Mexico is considerably less, and they are less exposed to any issues that the US and Mexico have over the next couple of months. So I actually think that this will do a more, you know, comparative benefit for Tesla in terms of their amount of costs for pumping out their cars, which I think is a nice upside that no one was really paying attention to when the tariffs came out the other day and everybody started freaking out and auto manufacturers were going down, north of 6% each. So I definitely think that that's something that we should keep in mind going forward. But that kind of goes into this. If Tesla has the ability to either lower costs in comparison to its peers, or if any of its autonomous factory and its gigabyte factories really start to get into ramping up production in terms of autonomy and also self-sustaining energy with the amount of solar panels that are in each one, once Tesla kind of gets past their cost threshold, they will be able to drop costs considerably. Now, obviously, they've already been doing a lot of layoffs. They've been trying to switch more and more to more of an autonomous creation of each of their vehicles more and more. Obviously, that probably won't come to full fruition for another 5 to 7 years. However, once that happens and you look at the amount of growth that Tesla has been going through, Tesla's sales have been growing at north of 70% over the past 5 years. And if they're able to cut their costs considerably, even if it's down to say 82% of their revenue, the company becomes, valued at, like say what ARK Investment talks about, is it becomes a company that can be valued at over $4,000 a share. Now, obviously, going from, losing money to cutting costs down about 82% of revenue is a big jump, and it's not something that's easily done overnight. However, in the past year, there were 2 quarters that Tesla was actually able to get their costs down to that low 80% level, which is why they were explosively profitable for just a couple of quarters. And now, obviously, there are a lot of reasons why currently they're not profitable, whether it's shipment delays, the way that they take in their revenue, or because a lot of people are worried about the amount of demand that they're getting. I personally think that's all kind of up in the air, but when you look at Tesla from a long-term play, if you bank on them hitting that point of profitability, they become an extremely undervalued company by any amount of discounting you want to do. So it's very interesting when you look at the numbers, and I'll go in depth with these numbers when I do an in-depth Tesla analysis, but it's a very interesting play, in my opinion, if you have, the next 5 years to kill. Obviously, if we have a recession, Tesla can go bankrupt pretty easily, but if you don't see a recession happening, or if you, are willing to, say, gamble on a small amount of money on a very large growth stock that may or may not, be in its infancy still, I definitely think Tesla is worth taking a look at. The last company I want to talk about is International Restaurant Brands. So ticker symbol QSR. This company is the company that owns, and I've talked about it a little bit here on the channel, it's the company that owns Burger King, Tim Hortons, and Popeyes. So they franchise all of those brands out across generally the majority of America, mainly isolated in the United States and in Canada, but they are starting to penetrate into, say, the Japanese and other Asian markets, including China. And the company has been, in comparison to other fast food chains, especially for how old these brands are, these aren't like brand new chains that are just popping up, they are going under considerable growth, and that's ever since, they were privately bought out. 3G Capital took them over, they got new management that went in, and ever since then, they've been really running the company considerably better than they had been in the past. And so, if you look at their amount of growth in their comparable sales, now obviously, I believe in their last couple of quarters, or just in their last quarter, their sales have kind of slowed. But in comparison to, say, a McDonald's or a Yum Brands or anything like that, that's, at that level of brand recognition and that age, it still blows them out of the water. So I definitely think that even though that their sales are slowing down compared to what they were, it's still nothing to be, too shabby about. And management does think that, and they already see their growth going back to what it has been over the past couple of years, currently just because they had a one hiccup quarter. And I definitely don't want to discount a great company just because they had 1 quarter of kind of lackluster results. Other than, just their sheer growth, all the businesses are still running fine, and they're also doing a lot of very interesting and effective advertising schemes. And another thing to point out is that this business, all 3 of these businesses that QSR controls, are really non-cyclical businesses. No matter what happens, people that buy a burger or, get coffee in the morning or, want some fried chicken, all of those things are going to be happening regardless of if the economy is doing really well or really poorly. If anything, these you could say are inferior goods, and they'll actually outperform standard goods in hard times. So the fact that they're, going through a lot of growth right now when times are good on paper, I definitely think that, once things start to, hit the fan, I definitely think that these brands are going to stand the test of time and outperform some other companies like, say, a Starbucks. And their management team, I can do an entire video on just their management team. Their management team is pretty outstanding. So their CEO, he's relatively young. I believe he's about 32. And their entire C-suite for all of their offices are just completely open door. If you go to their headquarters, you go up to, like, say, the 5th floor or whatever floor they're on, and everything is just completely open. And if you want to, you can just go and walk directly to the CEO, no appointment, and just ask him a question about the whole company. This is probably one of the most open management structures out there, and it has definitely shown that all the employees down to the very low, say bottom of the tier level, respect their CEO for doing this. The CEO also, when he took over, he started working for a couple of weeks at each of the chains to really figure out what life was like at the bottom, and really figuring out, okay, from an employee standpoint, what needs to be innovated, what needs to be focused on, and what can you actually expect out of them. So having a CEO like that, I think I would personally want, and I think that people would really connect to that, and I think that they're going in the right direction. And finally, the amount of innovation that they're doing, if you look at, say, like the Burger King app or the Tim Hortons app, or you start to look at, the amount of growth in users that these apps are getting, it's great. They're essentially copying, more or less, what the McDonald's app is and then what the Starbucks app is. Became increasing sales drivers for those very mature companies and very large companies at that, with hefty valuations. So with restaurant brands finally starting to kick this off for multiple brands, even if only one takes off, it could drastically improve their overall sales. I know for one, with the Starbucks app, both of those apps quite often, and the same thing with Dunkin' Donuts. You have to load it, $10 at a time, unless you have your credit card linked up to it. And when you link it, you can't really take that money back. So you're pretty much lump summing, say $10 to $100. You put the money on the card, and then when you look at only having a couple dollars left, you just say, F it, and you buy an extra item because you know that you're not going to be able to buy another item with, say, $1.50, by itself. So it's a pretty ingenious way to just funnel more money in. So it's like almost as bad as a credit card for, these fast food chains. But it's just a way for them to kind of lock in and secure profits, because no matter what happens, once the money gets loaded onto the card, it's going to be sales. They don't count it as sales, but it pretty much is sales. So I definitely think that direction for fast food companies is great. And that's another reason why I think that Restaurant Brands is going to be doing just fine in the future. So that's it for the 3 stocks for the month of June. Hope you guys got some use out of this. Let me know what your guys' picks are in the comment section down below. And let me know if you guys have any other opinions or, comments on these 3 companies that I just briefly went over. But I'll leave you to that, and I will catch you guys in the next video. Peace.